to a really great financial future. Tom and Don are talking real money.
Ladies and gentlemen, it's Monday. Welcome to Money Mondays, readings from the good book, Financial Physics, by yours truly. It's our Monday thing for a while. Hi, everybody. Welcome to Talking Real Money, the Money Monday Financial Physics, way too alliterative and tongue-twisting edition of the program. I am Don McDonald. I wrote that book, Financial Physics. Along with me is that guy over there who's going to do the readings today. He'll step up to the podium and give you a little reading from the good book.
No, it's not. Is that a different one? Is that the?
And you get to ask us questions later on Talking Real Money.
We got a lot of those.
We got a lot of those. Questions sent in at talkingrealmoney.com. Thanks so much for joining us. We really love the fact that you're out there and you're listening. And you know what we found? You're telling your friends like we asked. Thank you for doing that. Our numbers are going up. Our reviews, we still get like
it's about 4 to 1.
We get about 4 or 5 stars to every 1 star, and it's 5-star or 1 star. We are either loved or loathed. It's just there's no in between.
My daughter now gets reviews because she's a pizza delivery person.
Oh,
so she's perfect 5 stars. She was laughing at me. She goes, "You're not perfect." I said, "No, we're not perfect." So,
and I would have hoped you'd learned that about your father many years prior to.
This. She's still young.
Yeah, it's true. Well, but she's old enough to know.
Oh no! She call me loud and wrong? That's my favorite. Just loud and wrong.
Aren't you glad Aren't you glad? I mean, really, in a way, aren't you kind of glad they get an opportunity to go away to college so they can appreciate you more later?
Oh yeah, I hope so.
No, it's true. Well, my daughter, now in her 30s, she really appreciates me more, and I don't know that it's just the financial spigot. I think there may be something else.
I hope so. I really do. So. You're a better dad
reading
than I am.
from the good book, Financial Physics
now, ladies
today.
And gentlemen,
Chapter 3. Is that what we're up to?
Rule 3. Rule 3. Financial fluctuation. Speaking of alliterative.
I love alliterative statements. Phrases.
And he came from the desert. Is this the right one?
That's the wrong book.
No.
You were in a hotel and you took that Gideon book. Wrong one.
Sorry about that. Okay, what we're talking about here is, this is pretty simple, actually, but it tends to be overlooked because...
Or overdone.
Yeah, that's true. But most people, when they buy a security and it goes up for a while... Mm-hmm. Most people think that's a permanent, that it's just always going to go up, right? It's like real estate was in the late 90s. Right? Real estate only goes up.
Yeah, well, basically what goes up will go down, but we hope not as far as it down as it went up. Basically, that's the law, the theory, the physics of it.
But it's people are in denial, I think, generally about this. I'll give you a local example. I've talked about this. There's a certain software company that's down the road. That's not Don's favorite, but they are, I think, the second largest employer in the state of Washington now. They're called Microsoft.
Behind Boeing.
Been around for a while.
Right?
No, I think it's actually
Amazon.
Amazon. I think Amazon.
Yeah, I guess Boeing's probably third. You're right.
Yeah, something like that. Anyway, I mean, they're people that got in on the stock when it was originally sold in like 1985 or something. They've made a lot of money, right?
Yeah. They have.
It's done well. But there are periods of time, and there were, for example, and I think you call them the aughts, the 2000s.
The double O's, yeah.
The double O's. Where the company lost money. And recently, the stock is down like 40% from its high. But people, if you ask them, they would say, no, it always goes up. Microsoft always goes up. It always goes up. Well, no, it doesn't always go up.
But on the opposite side of that coin, though, there are the zero-summers. The people who believe investing is more like Vegas, that for every dollar gained, there must be $1.20 lost or something.
Yeah.
And it's neither one of those. It is a much more nuanced rule. Things go up, and they will go down. They will, at some point, somehow go down. Either companies become, like Microsoft, they become dominant in their industry, and then they stumble. Another great example in tech is IBM. It was dominant, stumbled. AT&T, dominant, stumbled. This happens all the time. with individual securities. However,
And with markets.
and with markets.
Yeah, right.
But with markets, it tends to be temporary. With individual securities, it can be permanent. But
Right.
in aggregate, the good news is what goes up tends to come down, but in aggregate has tended to go up again even more. That's the
I love
wonderful
this
part
quote.
of the theory.
You got a pull-out quote in the book here from J.P. Morgan, which I love. When asked what the stock market would do, J.P. Morgan responded, "It will fluctuate." I think that's that's a perfect, and in your book you talk about standard deviation, which is a very important number.
It's a measure of volatility.
Yeah, sort of outside of the ups and the downs.
Something that never changes in value. Never. I mean, and good luck finding something that never changes in value would have a theoretical standard deviation of 0. I don't believe anything has a standard deviation of 0. Nothing.
No.
Even a dollar bill in your wallet is fluctuating in its purchasing power as it sits there in your wallet. So everything has a bit of a standard deviation. The S&P 500, I don't have the number in front of me, but it tends to come in around
14.
15.
Yeah, 14, 15. Yeah, right. Yeah, it moves. By the way, this came up in a meeting today, so I'm going to steal it from the person who said it. My standard deviation for golf, very high. Just so you know, I mean, it's very, 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 very
What's
high.
the highest standard deviation you have? Because mine is actually higher than that.
It's higher than that.
You
But the
can't be a
question at
worse
hand-
golfer than me.
Here's the question.
I score by number of balls lost. If I'm under a dozen, I've done well.
Everybody wants to know, how do I make a lot of money and not have the standard deviation?
Can't do
That's
it.
that's the end of the day, what everybody wants to know. Check that box, right?
Yep.
And your book has a nice little chart in here that shows when you own a lot of a lot of types of securities: U.S. large cap, U.S. small cap value, international small cap, U.S. large cap value, U.S. real estate, international, all these things that actually over time, the ride, if you will, the volatility has been less. That diversifying is truly the right approach if you don't want to have your money like a bucking bronco, right? That's going up and down, and some days it's great and some days it's horrible.
It can never be truly eliminated.
No.
Volatility. It can be reduced, and really the reduction depends on how much you're needing and expecting to make from the money, because the more you need or expect to make, the higher the volatility should be. We really can take that word risk, the scary word, that means losing everything, out of the equation completely. If you have great diversification, then total risk vanishes for all practical intents.
Other than, the catastrophic collision
global conflagration
with something else. Yeah, I mean, that's exactly right. Well-diversified portfolio means everything. But I think you struck on something that most people, again, also overlook. That is, you need to know before you invest any money for you, for your kids, for anybody, what rate of return you're trying for and how much volatility you're willing to accept to get that. That's the two that don't get connected often enough.
And it's so simple. It's just simple to calculate. And once you calculate it, then you're set. Your portfolio can just be rebalanced back to that.
And you don't have to worry because it all falls together. By the way, Mark Twain wrote about this. You also have this in the book, which I love.
I remember what I have in the book.
This is so good. October, he said, this is one of the particularly dangerous months to speculate in stocks.
Oh, that one.
The other are, let me make sure I get this right, July, January, September, April, November, May, March, June. You get the point. They're all dangerous.
You mean it's
to
all of
speculate.
them?
It's all of them. Yeah. But for you, our friends, you should be diversified. I mean, and by the way, I just looked this up. VT, the Vanguard Total World Stock Index, you know how many stocks it now owns? I was surprised. I just looked this up.
I don't know. I thought it was about 11, 12,000, something like that.
That's pretty close, 10,700. So that's real diversification. That's big companies and little companies and growth companies and value companies. And you can get it all in one fund. You don't have to do any work. I think it's 6 basis points, 0.06%. It's a pretty good deal. But you should be diversified. You should know what rate of return you're trying to get. And then you have to be willing to accept the financial fluctuations. They're going to come. The bad days will be here. I don't know when. maybe sooner rather than later. But you got to be willing to accept them if you want to make that additional money. If you do not, and that's fine, then you do things like, things that have no fluctuation, right? Money market, I guess, basically. I mean, something very short term with your cash that's not going to kept up with inflation, but you haven't had to deal with the ups and the downs, the wild swings, the whatever happening in the geopolitical situation that's going to drive that, or the companies that are looking good one day and bad the next. But that's so key, and it's a lesson that everybody needs to know if you're going to be an investor. I see people that don't, though. They don't face it.
Once again, a powerful reading from the Book of Financial Physics, which, by the way, is, since we started reading from it, the sales on Amazon have skyrocketed.
They're up to 2 last week,
No, we actually, so far this month, 9.
Oh, my
Which
goodness.
is huge for that book. Huge. I mean,
by the way, before
60 of the other book, like the line across.
Great book. You got to expect volatility, but here's the one that I still love. You said this originally, so I'm going to give you full credit. When markets are at a peak, and we're basically there today. I mean, the markets.
Okay, but
who knows?
See, now
Who
you
knows?
opened the can of worms. It's at a peak, but it can go peakier.
Oh, sure. But here's the thing. You said this. If you're looking at your numbers and you're saying, I'm rich, et cetera, look at your numbers and then subtract 20%, because that could happen so quickly. That could happen this fall. And I always thought that was really good advice.
And that's if you're a 60-40-ish kind of person, somewhere in there,
exactly.
70-30. Anyway, so that's the book that's our Money Monday.
So is the reading.
Now we go to your questions that you sent to Tom at talkingrealmoney.com by typing your little bony fingers to the bones. And boy, did we get a bunch of them. So today, if we can fit them all in time, Tom pontificated a lot, but it's what he does. He was reading. We're going to try and get 4 in. Try.
Okay.
Can we do this?
Ready?
You think?
Yeah, I think we can.
Go.
I think we can. All right. This comes from Steve in Tulsa, Oklahoma. We don't get a lot of questions from Oklahoma, I don't think. Twice recently I've heard statements on the podcast that sound like you're saying people who are self-employed can't contribute to a retirement plan such as an IRA or solo 401k because they don't have W-2 income.
No, we never said that.
Well, he said
you gotta have earned income, which could be 1099 or W-2.
In a recent episode, he said May 21st, Tom took a call from a listener also named Tom. When the listener said he and his wife didn't have a salary from their LLC, Tom said that would disallow you from doing anything into a retirement type account.
Oh, well, yeah, you got to have a 1099 or a W-2, don't you?
One or the other, I believe.
Yeah.
I was getting to that. He said he concluded his option was only to open a brokerage account because if you have no income, I don't believe you can contribute to an IRA, Roth IRA, or Solar One 401k. Now, that income could just be the 1099, I believe, if you have an LLC. But even then, you get into the rules of they want you to take a salary because they want you to pay in Social Security. At some point, you have to pay that tax. So he goes on to say,
all right, but yeah, let's clear it up. Let's just go into the tax code. Okay, it depends on how it's structured.
And now we're reading from the tax code. No,
it depends on how it's structured, because here's the thing: even if you don't give yourself a paycheck, if you declare self-employment income from an LLC,
correct,
then you will pay self-employment tax on that.
You will.
Social Security, the 15%. And then you can contribute. But if this is where we probably needed to get into more detail in the answer.
Semantics, yes.
Yeah, because if you have an LLC and you're only taking, for example, capital gains to try to get out of paying some taxes, you're just like selling off shares or something, then no. In a partnership, yes. Your earned partnership income, even if you don't 1099 it or W-2 it, if it's declared on your tax return as net self-employment income,
then you could make the contribution.
But if it's an S corporation and you pay yourself no salary, it is not considered compensation for IRA purposes. You need to have W-2. Same thing with a C corp. Okay?
So it depends on how the organization is structured.
Right.
Per se.
A C Corp or an S Corp. Now, remember, with an S Corp, it's pass-through income.
Yep. That's right.
But it's not self-employment income. Therefore, it's not eligible. So the devil is always, when it comes to stupid tax questions, the devil's always in the details.
But think it through. The government wants you to pay yourself a salary type situation because they want you to pay into Social Security.
Right.
And then if you do that, then yes, of course you're eligible to put money in a Roth, an IRA, solo 401k, et cetera. But he's right that I should have been more
but that's fine.
expansive about my answer.
And that we keep saying that. We keep saying that over and over again with our answers.
Yeah.
We are giving very broad, very general answers. All right, next question.
Next question comes from Singapore.
Wait a minute. That's
Singapore.
not in the United States, right?
No, it's not.
No, that's in Asia, correct?
Shirley
that one.
writes, I'm writing to you from Singapore to express my deepest gratitude to Tom and Don. I understand you're canceling the show at the end of this year, and I want to say thank you. No, I added that part.
Please, now you're going to start it again. Okay, he's joking.
That was a joke.
We need an applause sign, but it's audio.
I know. I discovered your podcast on Spotify back in 2020, and it has been a staple of my daily routine ever since. Wow, thank you, Shirley. Before finding your channel, I was in a rough spot financially. I was 40 years old, unemployed, desperate to learn how to build wealth, but the financial landscape in Singapore was dominated by high-fee insurance-linked products. I tried managing my own money on IBKR, which I think is Interactive Brokers, but my frequent trading resulted in a decade of losses. I felt incredibly lost, genuinely feared that retirement was out of reach. Your show taught me the power of long-term investing. I added that emphasis. I pivoted away from day trading and high-fee local products, putting my retirement funds into SPY, 45%.
Okay, yeah, SP 500.
Yep. My cash into QQQM, 40%. I don't know what the QQQM is. I know what the QQQ is. And 15%
cash?
In various that's the bond portion, I guess, but we'll have to look into what that is. 15% in various stocks.
The QQQM is the NASDAQ 100.
That's not good for cash.
No.
So wait, so 45% in the S&P 500, 40% in the it is the QQQ.
Yeah, it's the QQQ.
Yeah, we don't recommend that,
no.
Shirley, but thank you for your kind comments. He says the investment account has surged from 20,000 to. You're right. Pardon me. You're 20,000 to 123,000, putting in additional money, et cetera, et cetera. Shirley's just saying thank you, but. Shirley, wait. Shirley, you can't be serious. But
Shirley, you're going to do it. You're going to do Shirley, you jest.
Yeah, because here's the thing. I don't need to read your very kind comments, which we appreciate. But this is not a good portfolio.
No, it's not.
This is all U.S.,
It's
right?
better than the insurance stuff, and it's certainly better than the day trading.
But if you're in Singapore, wouldn't you think you'd want to be in Taiwan? Which has been one of the best markets the last
No.
I mean, in general, international stocks owning Taiwan is part of that portfolio.
I thought you were doing that thing.
No. But you want to be in that, and you want to be in developed markets, and you want all those places. You're exposed to none of that. And having this portfolio, you're mainly exposed to large U.S. tech companies because they make up a hunk of not just the S&P, but certainly the QQQM.
I don't really have an issue with the S&P. What I really have an issue with is the specificity, and there's a lot of duplication between the S&P and the QQQ.
Yeah, absolutely.
Too.
Yeah.
If I remember correctly, I remember reading an article somewhere that Dimensional just started trading a few of their ETFs in Singapore.
Oh, is that right?
Yeah.
Oh,
I think the global core equity is available.
Is that just U.S.?
No, global core equity.
Oh, pardon me. Should have listened more
Dimensional
carefully. Global
core equity.
Yes.
And I also am pretty confident, I'm going to say really confident, that Avantis is too. AVGC is their global equity fund there. And that's going to give you broad diversification.
Yeah, way
Great
better.
place for your equity money. Now, your fixed income money,
Doesn't have any.
But she said she had cash. You need to have some.
I don't. That was the way she wrote it. She said, putting my retirement funds into SPY, 45%, and my cash into QQQM. I think what she meant to say was my brokerage account. Right,
Okay,
because
the
one's
cash in
retirement,
it,
one's brokerage.
But you need to have a fixed income portion to the
those are great
portfolio.
solutions.
And so I would look at Avantis or Dimensional. And by the way, BND is available to Singapore,
Singaporeans.
if you buy through your broker, and they trade U.S. listed ETFs. So Interactive Brokers Singapore, they do allow you to buy BND and these other ones. So if
you're listening overseas, by the way, Interactive's all over the place, and you can buy a lot of the stuff that we recommend.
It's so cool that we're getting a global marketplace for securities instead of these marketplaces that have been dominated by local banks and insurance companies charging ridiculous amounts. I applaud every country that has opened up their markets to these global portfolios that are at low prices. It's making a level playing field, not just in the United States, but around the world, and really benefiting investors in a gigantic way.
Now we go across the Pacific from Singapore all the way to Sedro-Woolley, Washington.
What was that again? Sedro-Woolley?
Sedro-Woolley.
I Sedro-Woolley. Do you Sedro-Woolley?
Not on this show, you don't.
Okay.
Scott writes us, hey, Ron and Don, I'm turning 55 soon and avoided bonds so far.
So you're Ron this time. Oh, good.
Yeah,
okay.
I'm okay to be with
Okay, so he's how old again?
55. Just don't call me late for dinner. You call me anything else. He said, but with my time horizon shrinking, they may be inevitable. He's speaking of the bonds there. Mm-hmm. Since my 401k has access to actual treasuries and bonds, it's less volatile to buy the bonds direct, or is BND a better choice? Thank you for your thoughts in your podcast. Should you buy freshly from Treasury Direct or just buy BND? Those are two very different things.
Yeah, and I think our opinions are going to differ on this one.
Go ahead.
If you are able to ladder maturities of treasuries,
if you can,
1 to 5
if
years,
you will,
if you want true non-volatility, that's the way to get it.
That will give it to you. Yeah. That's true. But it's okay to own BND.
Mm-hmm.
Yeah.
Okay. That was easy. Right. Then we have time for the last one.
Yeah. I mean, but here's the thing, by the way, because this just
elaborate.
came up. No, because it came up at a call today with a very nice young lady in your neighborhood, by the way. She sees you outside from time to time and wants to hit you with a slingshot, but I asked her not to. So,
my neighbor?
Because, she was asking me, she and her husband are going to move from a 90-10 portfolio to a 70-30. And I said, why? She said, well, because we're getting closer to retirement. I said, right. But what rate of return do you need on the money to retire?
Mm-hmm.
No idea. Gotta know that first.
Mm-hmm.
So if this guy
first,
says I'm
know what
bonds,
you need.
Yeah.
Second, know how much risk you can stand taking.
Exactly. I think you have a word for that: risk
profile. It's your risk profile.
Yeah. All right.
Tolerance and need equal profile. Yeah.
From Waldo, Wisconsin. Where is Waldo, Wisconsin? Do you know?
It's in Wisconsin.
That was too easy. Joel writes. I win those bad hosts laughing at his own jokes. Yeah. Recently,
we're all
that
used
was
to
so
it.
bad I'm laughing myself. I've recently noticed in my Roth IRA that I have at work that I can use a self-directed account.
Hey.
Is it a good idea to move some of my funds and put the money in AVGE and similar funds that I have in my 401k?
Mm-hmm.
Or is this classic overthinking that we all like to do? By the way, sometimes there's a charge using the outside account. You want to check on that first.
But usually it's a tiny little amount.
But here's what he has in his 401k: low-cost Vanguard funds, 20% large U.S. cap, 30% small and mid cap, 20% U.S. bond. He has some in the Vanguard International Equity. That's fine. That's fine.
And the costs are low, and it's simple.
Yeah, the costs are low.
No. Oh, yeah. Okay, I go with overthinking. Yeah, you're good.
Yeah, no, I think you're right. He's 56 with 9 years left before retirement. That means he's going to retire in his mid-60s. Then what? What are these people going to do?
I couldn't agree more. I remember thinking in my 50s, oh, boy, I can't wait to my 60s so I can retire and do. And then I I forgot to fill in the blank.
Yes, exactly.
I can retire and do.
My sister's in town, and she was giving me a bad time about it. She's like, why are you still working? I said,
what are you going to do?
I know. And then she said, "You remind me a lot of Dad." And I thought, I'm okay. You were the one who called my father, an exemplary member of the greatest generation. I'm okay being compared to my dad any day.
He was.
Any day. So
I mean,
I was
come on.
I'm okay with that. So.
Here's a dude who navigated bombers, right? Navigated?
Yeah.
In World War II.
That's right.
Went on to get his MD on the GI Bill, right?
That's right. Yeah.
Then went back into the Air Force again.
I know.
Then went 50. Back to practicing medicine again.
I know. It's kind of.
I think that's an impressive story.
Yeah. The last World War II veteran to retire from the Air Force.
I just think that's pretty,
I think it is, yeah. Anyway,
I think that's
the point
cool.
is, have a plan before you retire in your mid-60s.
All right, Colonel.
I'm working on a list, too, by the way, because the day that you say I'm not doing it anymore, I'm not doing it anymore. So,
really?
Oh, yeah. I've been very specific on the list. I used to just have these general ideas, and now I'm really honing right.
Where has soccer moved on the list?
Well, soccer's still there, but the question is what I can do.
Yeah.
Because my reffing days, as you know, are coming to an end.
You could be the video review guy.
And in the video review, I hate that. You know that. I hate that whole aspect. I hate that whole aspect of sports that everything has to be perfect all the time. I get it. There's a lot of money riding on it, but the athletes aren't perfect. They make mistakes. So
yeah, but then they get penalized when they make mistakes. The refs don't.
Yeah, they just go. Well, sometimes they do. Sometimes they don't. I've been penalized.
All right,
anyway,
send in your questions at talkingrealmoney.com. You can type them in. Just click on the button that says Ask a Question. If you want to speak them for the Friday Q&A podcast, that's become quite the event.
I know.
Eight questions in the last 2 episodes. We've never had that many in a Friday Q&A until the last 2 weeks.
Awesome.
And they keep coming in. Just go to talkingrealmoney.com, click on the microphone in the lower right-hand corner, or click the button that says Ask a Question. And for those questions that exceed the limited amount of time we have on our lovely little podcast to answer questions with our limited knowledge and information, this is just something you need for you. You're saying to yourself, gosh, I wish somebody would just explain this to me and not try to sell me anything. Well, we've been doing just that since like 2010.
Well, I want to be more specific about that because I had a conversation today with somebody was surprised. Because I think people, what they think is we're going to call them and we're going to give them a pitch on why they need to hire us.
No!
And I say no. And here's the part that you do get absolutely 110% free. 2 parts. Mm-hmm. Number 1. We take your portfolio.
Okay, wait, can I have to correct you again. It can't, if it's 110% free, you've got to give them some money.
Oh, I see. Okay, I'll give you $1. No, kidding, because I'll get 100 requests.
You will, too.
I know, because I made another offer recently. I got way more requests than I thought. Not even going to mention what that offer was. But we actually take your holdings. We give you a report that shows you, and most people are surprised by this, how much you own of this type of security, how much of this one, how well diversified you are, how much you're paying for all that, how much risk you're taking. And we give you a list of suggestions. Hey, you really should try this, et cetera, et cetera. And that's part 1. Part 2, you actually get to talk to a real life advisor, sometimes me, if I'm not on one of my extended vacations.
Right.
So
another one is coming up very soon.
Well, its sun is out. I got to get out of here. So take advantage of that. I think most people hear it and think, no, it sounds like a pitch. Mm-hmm. It's not.
It does. It sounds like a pitch.
Don't do it or don't.
It's kind of like when we say Appella or Dimensional. Are these guys being paid by Appella or Dimensional?
Oh, God, don't say it, please.
Yeah. I mean, I used to get it about Vanguard all the time.
I know.
And finally I was able to say, really, at one point I said, yeah, I am being paid by Vanguard. They're sponsoring the show.
Yep.
And because I said, well, you guys, you're making a lot of money. Sponsor my darn show so that I can make a living. But Avantis does not do that.
No,
nor
we
does
do
Dimensional.
That. No.
Nor does
anyway,
Vanguard.
So take full advantage of all the things we offer. That's the bottom line.
And look at that. We got out of this one in under 30 minutes with 4 questions. That is dedication to the clock. I'm impressed. Well, thank you all for being here. Please let your friends know. Continue to do so. I was just at a friend's kid's wedding, and a woman was there who was very confused about her money, didn't think she had enough to live on. I was talking to her about it. I told her all about it. She's going to be listening to the podcast from now on.
Nice.
And she had
And
more
I pumped up our numbers in Greece and Italy while I was
she
over
had
there,
more
too,
than enough money to live comfortably, and she didn't think she did.
I hate that people have anxiety about that.
Yeah.
It drives me nuts.
So anyway,
Find
thank you
out.
all for being here. Thanks for telling others. Please keep listening, as Tom and yours truly are always talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.